Welcome, everybody, to June's Verivest webinar. And today we've got a fun conversation with two fund managers, one on the newer side and one in the industry for about 10 years of running funds, talking with Matt about all things fund management. So take it away, Matt.
Thank you, Kylie. Appreciate it. And so thanks everybody for joining us. Good to have you here as we get started with the summer. Um, we try in these webinars to make them as informational as possible on different aspects of running funds for both new and existing managers and just touch upon things that can bring value to people. And today we decided to do something where we actually share some experiences of people who have started and running funds and kind of what they learned, some experience to share and that kind of thing to try to help people who may be already running funds or thinking about running funds and just learn from people that are actually doing it and hearing direct experiences of those folks. So today I'm joined by two guys that come to know quite well. One is as Kylie said, a little more experienced manager, been doing it for quite some time. And the other is relatively new, not in the business, but doing the first pooled investment fund. So we have Joel Wooster with Wooster Investments, and we have Sam Quadrat with Ryan Legacy Capital. So, guys, thanks for being on the program. Appreciate it.
Thanks for having us.
So why don't we start with we'll just let each of these guys introduce themselves here briefly and start with you, Sam, and just kind of give everybody a little context of kind of who you are, what you do. And we'll get in a minute to kind of the whole fun side of it, but just maybe a quick overview so people get some context of kind of your background. I think you're on mute there, Sam. It doesn't look like you are, but I can't hear you. I don't know about you guys.
Yeah, I can't hear him as well.
How about Joel? Why don't you start, and we'll start with Joel, and then we'll come back to Sam here when we get the technical difficulties figured out.
Great. Yeah, so two of my brothers and I started our company, an investment company, about 20 years ago. We're actually celebrating our 20-year anniversary. So right when I graduated college in 2006. And we had our primary business is multifamily. We started out doing single family rentals. We always had the goal of growing a large multifamily portfolio business, but we started out without capital, and so we had to raise a lot of capital from investors. And we started out small and just kind of worked our way up. 2009, we bought our first apartment complex and bought our second apartment complex. As you are probably aware of the timing, that couldn't have worked out better. So we've been very fortunate with the timing of the market. We've been just growing our portfolio, and we did our first large deals at what turned out to really be the bottom of the market. So we now have a little over 3,500 units, and that's still our main business is multifamily. We own about 30% of the equity, 35% of the equity of that, and the remainder is from investors. And then we launched. So we started in 2000, late teens 2000s. 2017 we launched Hawaiian Bros. We co-founded a restaurant concept that now has a little over 80 locations. So that's been a journey, and we invest in some other stuff where we launched venture capital, and then we have been an LP in a number of venture capital funds for the last few years. So that's kind of high level. We have about 120 member team, and about 90 of them are like specifically working on properties through our asset management, property management.
Yeah. Cool. Well, thank you for that overview. It sounds like you guys got a lot of stuff going on, so I'll be interested to dig into that. So, Sam, why don't you share a little bit about yourself and your company?
Fantastic. Now my headset is working. So I'm Sam Quadrat from Ryan Legacy Capital, managing partner. We're based out of New Jersey. We're a private credit firm focused on direct balance sheet bridge lender. We originate first lien bridge loans, 2 to 20 million. We'll focus on value add, multifamily, industrial, retail across 20 plus states. We lend our own capital. We make our own decisions. We service all of our loans in-house, and the borrowers always know the deal with the decision maker at the table. And now we manage our LCF1 fund, which is going to be our private bridge credit fund, putting together the committed capital behind our lending product.
Yeah, cool. So Sam, why don't we go a little bit more into that? So Sam is
Sure.
relatively new. I know that you hired counsel last year, somebody that we're very familiar with, Kevin Kim at Fortra.
Yeah.
Done a lot of work with Kevin over the years. So how did you decide, and why did you decide to launch a fund versus like how were you doing it before that? How are you doing it now? What did you anticipate it looking like? And just kind of walk us through your thought process on the decision to go the fund route.
Yeah, so around 2 years ago, we were doing all of our deals on a deal by deal basis. So we originated the deals, and the investors would come in on a specific loan alongside our capital, our bank lines. Around 2 years ago, we started hitting a little bit of a bottleneck where deal flow would come through and deals would start getting paid off, but the capital would not align since we'd have to re-raise the capital. And even investors would line up and to be ready to go. Entire process wouldn't align with the business strategy of bridge lending, which is always more about speed. It's about locking in stronger deals. And so we started entertaining counsel. We had a process to get to Kevin, but once we started working with Kevin, we started putting everything together, and it took us a little bit of time, but we got here today, and now it's all live.
So how has it been? I know getting it off the ground. I mean, compared to your expectations, because that's what I always try to help people through is, people have certain feelings and expectations of what it's going to be like, and then once they do it, they experience what it's really like. We'll kind of describe that, like what's been different about it. How long has it taken you? Kind of what stage are you guys at right now, and how are you feeling about it on a looking forward basis?
That's a great question. A a lot of I've learned a lot through this process, I would say. It starts off with starting entertaining legal, and from legal, we're starting to get the fund admin, and from the fund admin, it's starting to get to an auditor, and from that part, it's starting to get the investors and getting them moving to the accreditations. So, what's something that we thought would take a couple of months took us quite a while to get through all the way through the end of the process. Um, so at this point, we've gone through the entire process, and now we're actually starting to acquire assets under our fund today.
How is the environment out there right now, as far as you're seeing with respect to being able to raise capital and investor expectations and all of that in today's environment, as you make the move to the fund versus when you were doing it one deal at a time? That's always something else, Sam, I've seen with
Yeah.
people, investors that are used to coming in on a specific deal. Sometimes, may or may not like coming into a pooled investment fund. How has that been for you?
It's been interesting conversations. I do believe it has a lot to do with education with the investors. Um, our experience has been that most investors, once they've understood how a fund works and see the advantages from it and understanding the diversification of getting across all the collateral, it has been really interesting for them. And a lot of investors that we thought are going to come in with a smaller check size, they really want to come in with bigger check sizes. And
Good.
which is very, very, yes, I would say it's very good. We're excited about it. A lot of investors have been falling out. Either they're too small, they're not accredited. They just want to have personal control over deals, and that is something we've been trying to avoid from our end. Since as a private lender, we have our guideline system. Is anybody that's running a fund to have their criteria and their box of what it is they're doing, and they're rather have an investor that says this works for me versus an investor saying, oh, I want to be able to control every single deal that's coming in and seeing, you know, this deal I do want to be in and this deal I don't want to be in. So the diversification really helps a lot getting on better and bigger investors versus being able to get out the smaller investors.
Yeah. So let's say, Joel, I know it's going back a little ways for you guys, but if I recall, and as you mentioned here, you guys started kind of syndicating deals on an individual basis, and then at some point you went to a fund. But if I recall, the fund was more of a debt fund, right? And then you've done a venture fund. I'm not sure you guys have done an equity style fund. Sounds like that's what you're getting ready to do. Well, just kind of maybe walk us through a little bit of your journey on why did you decide to start a fund? What was the thought process there? What was different about it than you thought, going in?
Yeah, great question. So yeah, we started out doing syndications, and from 2008, 9, all through through for the next basically 10 years, we would only do syndications. So, and we just the investors that we had attracted early on were pretty. I mean, we were pretty green. And so we ended up attracting a group of investors that were pretty sophisticated, but were so they wanted to be pretty hands-on, had experience with real estate, but they were kind of retirement age. So they liked to be able to pick their deals, but didn't want to, do all the work. So we had some great relationships there. And so that's why we kind of kept that, kept doing syndications, and just the fact that we were doing equity deals, just having to, it would have just added a layer of complexity. We would have had to be constantly valuing the properties and, resizing the loan, or, revaluing the fund and all of that for new investors. So we had a pretty comfortable thing going. And then we decided to launch a private lending business unit. So that's what precipitated doing a fund originally. So Matt, you're correct on that. But we created it as a, it's about, I think it's about 60% debt and 40% equity. So we've continued to do syndications for real estate equity, but we have used it as a supplement for it as first right of refusal on anything we do. But on an equity deal, because we're doing larger multifamily, it's just a small piece because our fund it started about 10 million, and then we've grown it. We did open-ended fund, and I think it's 26, 27 million now. And our average distribution has been 8 or 9%. So, so a lot of that is just more capital coming into it, and some of that is unrealized gain, the difference between the original 10-ish million to the 26, 27 now. But
for context, yeah. Joel, so like say 26-ish million for the fund, what sort of equity across the syndications would you say you guys have? Just to give, there's a question in here for both of you guys just about fund size, equity raise, total levered asset value. And so for each of you, maybe just kind of give us some context, both in the fund and outside the fund on the rest of your business.
Yeah. So I'll try to answer your question, and you can correct me if I'm not addressing it exactly. But we have about 700 million of assets under management total. So, and the fund on the equity side, the fund is a very small piece of that. So
yeah,
we have probably 10 million about of equity. So that's a very small sliver. There's debt behind it too. So the fund is just investing alongside our other investors in our equity deals, and it's a small piece usually. And it's just if there is capital available. We have a line of credit that we've grown over time with the fund, which has been helpful. So if we have an equity deal that we think is going to be meets the criteria of the fund, then we will pull on the line of credit. Or if we have cash, we will deploy into a deal. But the primary thing we do is debt. I mean, we've ended up doing more equity than we kind of planned, but the fund does most of our new loans that we originate.
Yeah, so in your case, the fund is an augment to a broader business across a number of different asset types. And it sounds like you're getting ready or geared up to now do an equity fund for the first time, which makes sense, right? After you guys have been doing it now for 15, 20 years and kind of reached that point where it makes some sense. And it sounds like you also have a venture fund what is so you like you dip into some other areas, but just sort of like when you think of funds in general, like what has been your experience in terms of how those funds have behaved and how the whole operation of that fund has been for you guys compared to like what you envisioned when you went
Yeah.
into it?
Yeah, our fund experience has been incredibly positive. I mean, we did it because we want the diversification. We want, we want to limit the amount of time that we spend communicating to investors per deal, especially if it's a private loan. So we we launched it. I mean, we had about, I think you and I and your team had about 6 months to a year back and forth, and I feel amazing about how we structured it. It's been one of our kind of most seamless investments or vehicles for investing. Just that it's performed really well too. So we structured it really well, I think, to attract. So you pushed back on terms like we know our investors pretty well, but you were, and our goal was to have it be very flexible for us and what we invested in, um, and the redemption period. There are a lot of things that you push back on. And I feel really good about. I would have been more aggressive, and we probably would have raised less money. And the concessions that we did make have not been a problem. So I'm always concerned about. I don't want something in writing from 3 years ago to dictate how I make a decision today, if I can help it, because it might be a different environment. It just might not make sense. So, but I really enjoyed the process of just going back and forth on like playing out possible scenarios of what could happen. And there were some things where you were like, well, what's the likelihood of that happening? And we kind of played it out. And I'm glad we made the decisions that we did. But it's performed. We're fortunate to have we've had a very strong performing fund, and it's our lower risk investments too. So it's been a nice vehicle for people who want to supplement the equity, which is that can be higher risk. Whereas this has been the equity that we do put into it, they're like less speculative deals. They're very cash flow focused deals, so they've performed well, and generated strong cash flow, and then the loans have done well as well.
Well, it sounds like it stood the test of time, which is good.
Yeah.
How about
We
you?
did
How about you,
open-end.
Sam? Sorry, Joel. So
No,
how
we
about you?
did. Oh,
Go ahead,
sorry.
go
Go
ahead,
ahead.
Joel. Finish up.
I was just going to say it's open ended, so it's still. That was one of the things we went back and forth on whether to have closed ended, and our next funds are closed ended. So
Yeah.
that's something we went back
Yeah,
and forth.
it's much harder to do an open-ended fund with a
Exactly.
bunch of equity investments for sure. So
Yeah.
there's a lot of it creates a lot of moving parts that are not the easiest to manage.
Yeah.
How about you, Sam? Give us some context on kind of your business and size. Sounds like you've been doing private money loans for quite some time on a one-off basis. So you've got a lot of experience on the lending side, but now kind of moving to a fund format. Maybe just give us some context there.
So we've done origination. We've done about $250 million over the last few years. Over the last short few years, we've done mostly on our balance sheet around 150 million to date. We're doing about approximately 40 to 50 million dollars. Our goal was really to kind of stabilize ourselves in the market, creating ourselves a niche product to where we're going to be more aggressive. And now with our fund, we are going for $100 million to be able to put out approximately $300 to $400 million on capital on the street. Our fund is starting off with about $60 million in assets. So kind of gives us a good leeway to be able to do the capital raise. And as we keep going, our investors know they can come in immediately. They can put in the capital immediately. They're making money right away. And we found that to be a pretty good setup for ourselves. So even it took us longer, like I said earlier, kind of worked out now that we're actually live.
So it sounds like both of you guys are using some leverage in the fund. I know
Yeah.
that's always a question I get in a lot of the engagements that we do and clients that we have is the use of leverage, how how much leverage should you use? Is it good to use leverage and why? Maybe you guys can each share your respective experiences on the use of
Sure.
leverage, what you like about it, how you've kept it under control, how is it structured?
For
Why
my
don't you start with you,
business,
Sam?
sure. For my business, leverage is key. Our assets are very much on our own end, very much income producing since they're a loan. So they produce a lot of cash flow on our end. So for banking products or for institutional partners, we have a very strong business with a very good income. So bringing in leverage is a very important part for this industry. Um, that's what I can say as a basis for leverage on our end. It's we can go up to sometimes to 65, 75% leverage, depending how good the deal is. The stronger the deal, will usually go higher on the leverage. The more volatile of a deal will usually go lower on the leverage.
And you've been able to lever them on a deal by deal basis, it sounds like in the past. Are you able to get similar leverage at the fund level?
Yes, yes. On the fund level, it depends. Each bank is different, but overall, they're very fond of the industry, so they're pretty flexible. We can do it on the fund level. We can do it on deal by deal level. Today, you have a lot of industries starting to come in onto node on nodes. That means not only is it a line of credit, they just do it individually, each deal specifically
Yeah.
on its own. So it's been it's a very much of a growing market, the levered world in this industry.
Yeah. How about you, Joel?
Yeah, so we only have about a $4 million line of credit on 26.7 million. And so it's a small piece of what we do. It's helpful just for flexibility and keeping capital deployed, but we use it more to make sure we can do a deal, that we really want to do that makes sense, but maybe we've deployed everything. So, but then we will, pay it off. So we usually have, you know, 2 to 3 million of it roughly deployed, rarely the full 4 million. And that's grown over time. So basically every year we reevaluate it, but it's like 15% of the fund. So it's very, it's not, we use leverage for all of our equity deals and a lot of other stuff. But for this, it's just the type of vehicle it is for our investors, which is low risk. We are, um, we're not looking at this as like leveraging, creating a better
Yeah.
return. Although we do, and because we keep some of it deployed, so it has helped a little bit. But it's more of a vehicle for flexibility.
Yeah, I'd say that different funds will use them in different ways. Sometimes it's higher leverage to help produce additional yield, and other times it's lower leverage just for cash management purposes, and sometimes in between. So it really varies from one manager to the next. So what advice would you give folks that are, I mean, I'd say like our core client base are, I'll call them real estate and private lender folks that are running usually pretty significant businesses, both like you guys, hundreds of millions of dollars, and they may be doing it in syndicated format or individual loans or fractional deeds of trust, right? And then at some point, they're involving a fund into that business, either exclusively in some cases or as part of what they're doing on an overall basis. But either way, for somebody I call like a real estate entrepreneur who's doing investments for either direct ownership of real estate or debt and thinking about a fund, what advice would you give to people going in? How would you coach them to maximize their effectiveness and minimize their expenditure?
You can go first if you want to say no.
Sure. Uh, I would definitely recommend to open up a fund. That's always going to be the right direction to go, in my opinion, especially if you have deal flow. It will be the one of the biggest key to set yourself up. If you have deal flow, then a fund is definitely a right direction. If there is no deal flow, it could become a very expensive direction to go to, and calculating just the opening cost, operational cost, idle cash is just going to be
Yeah.
extra pressure. So if the deal flow is there, I believe it's for the fund manager and for the investor and for underlying product itself. In my case, it would be the actual loans. The fund direction is really the most sufficient way on operation.
What about you, Joel?
Good. Yeah. Yeah. I think the most important thing is to know your investors. So try to have an idea of who you're going to raise the money from. Now you're not going to, you're not going to know right away, or you're not going to know where all the capital is going to come from. But, if you can try to find, if you have, like in Samuel's case, where you can warehouse deals, if you have deals like to start the fund with, that's great. Cause then your investors get a look at it and you have a picture of who your investors are going to be, and you can tell them with real assets. But trying to find an anchor investor, even if it's like $100 million fund or a $20 million fund, the size of that anchor investor is going to vary. But trying to have someone who you're confident will invest with you, and that will help you, make decisions on, because there's a lot of variables, and Matt and his team do a phenomenal job of taking you through all those factors. And then but like your investors are going to dictate that. So where you give and take, is going to be dictated by your investors to a large degree. But also, uh, the second piece of advice is like really go deep on the variables of like what could happen. We had a long redemption period, which worked out. It's harder to raise money with a long redemption period, but it's something Matt pushed back on, which we had some great dialogue on. But just because we knew our investors and we knew we had kind of long-term minded investors, it's really helpful. It was really helpful for us to have a long redemption period, especially as we were just getting started. Now we have we've changed that structure. We made it more, a shorter redemption period for our investors, just because we kind of had a better feel for the risk of that. But understanding your risk, like what's the worst thing that could go wrong, like what's the worst case scenario, that's incredibly important. And try to have safeguards in place to where you can pivot and um, you know cover yourself if you're in a tough position.
Yeah, I think one thing I've learned the hard way is that it's impossible to really fully know what you're getting into until you're there.
Yeah.
I always use the analogy of having children. It's until you've done it, it's pretty difficult to fully appreciate what
Yeah.
what you're going to be dealing with. But it's just part of life, right? And if you're going to do anything, you have to do it. As we get toward the bottom of the hour here, if anybody has any other questions, please feel free to type them in the Q&A box. And while we're waiting for that, fellas, maybe just one last question to you guys is sort of what's on the horizon for you. So I know, like in your case, Sam, you're just really kind of getting the fund off the ground. You're trying to get to 100 mil. What's your feeling about kind of the pace of raise? How's the market environment out there for what you're doing? And what do you see on the horizon for your fund over the next, let's say, 12, 18 months?
From our end, the market has kind of moved to a direction where transactions are starting. A lot of the stress has been coming up. And through that process, a lot of investors have moved out of specific investment vehicles and they do not want to move back into the same market. So for our industry, we've seen a lot of investors deciding to come towards credit. And on the other hand, we've seen a lot of real estate operators starting to purchase a lot of distressed assets. So over the next 12 to 18 months, I'm seeing very active distress acquisitions going on, especially in the Sun Belt and in the mid states around the country. Even sometimes it can go a little bit north as well. There's a lot going on, and auctioneers are getting busy. Banks are starting to offload. Short sellers are starting to activate. So we've seen a lot of that, and we see ourselves being able to fill up the entire plan that we were planning to do. But even we get to 80%, I'll be quite happy.
Do you think the on the capital raise side, do you feel pretty good about your ability to fill that up and be able to absorb that volume?
I do. We've been getting a lot of requests regarding this. So it's going to be a process. I would say, especially now with beginning of the fund, we'll learn quite a lot how to set up with our process. Verivest has been fantastic. I mean, especially with the latest products that have been rolling out, it's been amazing. And we've learned a lot with our onboarding on how to onboard. And we feel very confident that we should be doing well in that area. And on the other hand, one of the plus sides of our position of lever is we can always lower our leverage positions to always to be able to keep our investors bases higher. So our goal is going to be to capital raise, and keep lending out on our products that we're focusing on.
Cool. How about you, Joel? Sounds like you got another fund on the horizon. So what's your thinking in terms of launching that now at this point in the market, and what do you see on the horizon there?
Yeah, so we are hiring our the individual to kind of run the fund to lead with that fundraising component. And it'll be an equity fund, 100 million, and so we're a few months away from launching, but we're pretty close to to hiring someone to get that process started. And the first goal, and we are for the first time, we're going to institutional capital, which we've never done before. We have some kind of small family offices are our largest investors, and remainder are, we have about 350 investors, and most of them are accredited investors in that 2 or 3 to 10 million range. So we're kind of, and I, to Sam's point, I feel for the first time that we've seen some good opportunities that we purchased just on the syndication side with multifamily, and I think there's going to be a window of opportunity. I won't get into the details of all my thoughts on that, but I do think there will be. This is the first time I've really been excited about having a fund to do equity, because there's some complications on doing equity deals and syndication has worked out well for us. But just the volume that we want to do and we want to be able to do if the market provides the opportunities, we just can't do that syndication wise. And
Yeah.
so yeah, we're excited, but we're a few months away from launching that.
Yeah. Yes, I had a couple of questions here. One is looks like a Verivest question, but do we work with syndications or only funds? The answer is we do. We work with both. I'd say our primary business is fund administration, but many of our clients are, like Joel, syndicators as well. So in a lot of cases, people have both syndications and funds. Sometimes they're starting off with syndications only, and eventually moving toward a fund. But we actually do both. So if anybody's interested in chatting you're more on the syndication side, happy to discuss what you're up to, what you're looking to do, and have a conversation. Another question is, what type of concerns might you have for raising capital for a note fund where acquisitions of product come after the capital raise? And I'd say it's typical in any loan fund. Is like it's a blind pool, right? The investor doesn't know what exactly the combination of loans that they're coming into. I think part of how I would interpret that question is how do you manage the timing of bringing in investors, with the timing of deals, because it's never a perfect one-to-one match, right? You need to have the money to do the deal, but you need to have the deal if you're going to take the money. How do you guys manage, since you're both doing note funds? Maybe you could each just give us a quick minute or so on your thoughts on that.
For sure. On our end, that's where leverage really comes into play. I would definitely say that's one of the biggest keys why it's being used in the fund structures a lot. So you can always move down the leverage positions, raise the capital. It may affect yields a little bit, but overall, on the long term, they balance out.
Yeah, so you're using the warehouse line to fund the deal on the front end, and then you got the deal there, and then you can raise the capital. So I suppose as long as you can get the
Vice
lines.
versa. You can raise
Yeah,
the capital, lower the position, and then we
yeah,
have the money ready for the next deal.
yeah, yeah. How about you, Joel?
Yeah, I mean, we created the fund originally so that we knew we had capital available for for private loans. So we weren't doing syndications and having to scramble, because we wanted to close very quickly. A multifamily deal, we usually have 60 to 90 days. A loan, if you're doing a good job, you want to be able to close very quickly and have the capital available. So the fund structure was big for us. But I mean, we had to raise money kind of blindly. So and you can usually structure it so that people are making commitments and not putting it into the deal yet, and you draw on their commitments. And if you have good relations with people, you'll probably get 95% of those or something. Matt probably knows the math better than I do, but but yeah, we did when we raised for the fund, like there weren't any investments, so it was just kind of a trust. Those initial investors just trusted us, and our track record was important. Yeah.
Yeah, and there's ways that you could set up the fund and so that you can take the money in the form of a commitment or even a deposit without necessarily having to start paying immediately, and put some timeframes around it. There's lots of ways to address that in the structure of the fund on the front end. Well, guys, appreciate you guys both being here. It's been an interesting conversation, and I'm glad you guys should be here. So thanks, fellas. If anybody ever wants to reach out to these guys for any reason, here's the information on the screen. So feel free to shoot them an email or reach out. And guys, thanks for being here.
Thank you very much.
Thank you, Matt. Really appreciate it.
Yeah. So guys, thanks again. And everybody, thanks for coming on the show. We'll be back next month. I believe next month we'll be hosting a group that has a platform for raising capital through broker dealers and registered investment advisors. It's quite the online platform, so it should be a super interesting conversation next month. We're working on putting that program together for you right now, so please join us again next month. And thanks everybody for being here. We'll see you later.